Something extraordinary is unfolding in global metals markets that most people are completely missing. Chinese speculators, drowning in liquidity and desperate for investment returns, are catapulting copper, gold, and silver to unprecedented heights. We're witnessing roughly $7 trillion in household savings mature this year with absolutely nowhere productive to deploy. That mountain of capital is flooding commodities futures at a staggering rate. Let me be crystal clear. This represents the single most critical dynamic in precious metals right now. It trumps Federal Reserve decisions, inflation statistics, even geopolitical chaos. When $7 trillion hunts for returns in an economy where property investments are bleeding money, bank accounts pay practically nothing, stock markets face intense regulatory scrutiny, and bond yields barely register, that capital must find a home. Currently, it's pouring into gold and silver. Before we dig deeper, drop a comment telling me where you're tuning in from. I see viewers spanning the globe in this community. United States, Canada, UK, Australia, Germany, India, Singapore, Hong Kong. Let me know your location. Quick critical note for newcomers. This channel has never and will never solicit money in any form whatsoever. No paid subscriptions, no exclusive groups, no donation requests. Anyone claiming to represent this channel while demanding payment is running a scam. Block and report immediately. This channel delivers factual analysis covering both bullish and bearish perspectives. That's how genuine markets function. Anyone guaranteeing certainty in unpredictable markets is selling you something, typically disappointment. Now let me expose what's actually transpiring because this story dwarfs the headlines. China's M2 money supply is expanding at 8.5% annually. Absorb that figure. Meanwhile, nominal GDP growth sits at merely 3.9% as of late 2025. That's a massive 4.6 percentage point chasm between money creation and actual economic output. Where does that surplus liquidity flow? It must go somewhere. Money refuses to sit dormant. It hunts returns. Right now, the path of least resistance leads straight to commodities futures markets. This isn't speculation. This is documented reality. The People's Bank of China possesses the capacity to ensure abundant liquidity and suppress interest rates. They've been executing exactly that strategy. But here's their unsolvable problem. They cannot manufacture compelling domestic investment opportunities. The real estate sector is imploding. Fixed asset investment has contracted for the first time ever recorded. Banks extended fewer new loans than any period since 2018. Where precisely should productive capital flow? The answer is financial assets. Gold, silver, copper, aluminum, nickel, steel. We're observing record activity in futures markets across all these metals. The driver isn't industrial demand. The driver is surplus liquidity chasing any return in an environment where traditional options have catastrophically failed. Let me provide specific numbers, because data matters infinitely more than narratives. According to the latest market reviews, Shanghai supplier quotes show premiums of 3,500 to 3,800 yuan per kilogram. Some suppliers are holding prices absolutely firm at these elevated levels. Certain suppliers, concerned about potential premium collapse, made last-minute procurement at premiums of 2,300 to 2,400 yuan per kilogram. In South China, smelters offered cargo at premiums of 2,400 yuan per kilogram. Some suppliers mentioned slightly reducing premiums to 3,200 yuan per kilogram because transactions at peak premiums have become extremely difficult. Read that carefully. Transactions are becoming difficult at high premiums. This is massively significant. When premiums get so inflated that actual physical deals slow dramatically, it reveals something crucial about the sustainability of current price levels. The physical market is broadcasting signals that the futures market may be completely ignoring. Here's where it gets genuinely fascinating. The Shenzhen market, one of China's largest physical gold and silver markets, is showing declining procurement and stockpiling enthusiasm. A powerful wait-and-see sentiment is dominating. Overall transactions are described as relatively weak. After the overheated market cooled, buyers are retreating. This is the divergence I need you to grasp. Futures markets are exploding on speculative liquidity flows. Physical markets are displaying caution and weakening transactions. When these dynamics diverge significantly, one eventually must adjust. Either physical demand accelerates to justify futures prices, or futures prices correct to meet physical reality. History overwhelmingly suggests the latter. Let me ask you directly, are you observing this divergence between paper and physical in your local market? If you purchase physical silver or gold, what are premiums looking like where you are? Drop a comment. I genuinely want to understand conditions on the ground globally. Now let me explain the structural shift creating this liquidity tsunami. Approximately $7 trillion in household time deposits are maturing in China this year. That's not a typo. This vast savings pool accumulated over recent years amid property sector instability and lackluster equity returns. Chinese households facing uncertainty about real estate values and stock volatility parked money in time deposits. Safe, boring, low yield, but safe. Now those deposits are maturing, and savers face a critical decision. Let me walk through their options. Real estate is perceived as actively losing money. The property crisis is extensively documented. Developers defaulting, prices falling across cities. The cultural assumption that property always appreciates has shattered for countless Chinese households. Bank deposit rates are pathetic. Why lock money for another term at yields barely matching official inflation, much less real inflation? Equity markets face regulatory pressures and brutal volatility. Chinese stock markets have frustrated domestic investors for years. Periodic sector crackdowns create persistent uncertainty. Returns have been disappointing compared to alternatives. Bond yields are subdued, not compelling enough to attract significant capital from yield-seeking savers. What remains? Gold and silver. These are emerging as rare investment options where alternatives have systematically failed. Gold carries additional cultural significance in China as a store of value and household savings, extending beyond mere financial hedging. This isn't just about returns, this is about trust. Chinese households trust gold in ways they no longer trust property developers or stock markets. The data confirms this shift is real and accelerating. Gold-backed financial products in China have more than doubled in number over 2 years. Their total value has increased 8-fold. Let me repeat that. 8-fold increase in value over 2 years. This isn't marginal reallocation. This is a material transformation in how Chinese households store wealth. Now I need to provide the honest risk assessment because this channel covers both sides. The bullish case is obvious. Massive liquidity seeking limited options. Structural demand from the world's largest savings pool. Cultural affinity for gold. Supply constraints for physical metal. All these factors support prices. But the bearish case deserves equal attention. The divergence between futures prices and physical demand creates vulnerability. Manufacturing entities relying on these metals for consumer goods and infrastructure have scaled back procurement rather than absorb inflated costs. When industrial buyers step back, it signals current prices exceed what the real economy can support. The fervor in futures markets stands in stark contrast to softening physical demand. This disconnect signals a potential asset bubble, where financial valuations are divorced from underlying economic fundamentals and real-world consumption. Market participants cite long-term justifications. Currency debasement for precious metals. The green transition creating structural demand for copper and silver. AI-driven demand for various metals. Data center buildouts requiring massive copper inputs. These are all valid fundamental arguments. But here's the brutally honest question. Do these long-term factors fully explain the current price trajectory against a backdrop of deflationary pressures and industrial overcapacity within China? The answer is probably not. The speculative component appears dominant in current price action. That doesn't mean prices cannot climb higher. Speculation can persist longer than fundamentals suggest, but it does mean the risk profile is significantly elevated. Let me discuss what the People's Bank of China is doing, because their policy decisions directly impact the situation. The PBOC is committed to economic support. They desperately want to stimulate growth, encourage lending and investment. But they're also deeply wary of asset inflation. This creates an impossible dilemma. If they ease policy aggressively to combat sluggish growth, they risk exacerbating bubble concerns in commodities and other financial assets. If they tighten to cool speculation, they risk strangling the economic recovery they desperately need. There's no easy solution. Historically, the PBOC has opted for targeted liquidity measures rather than broad rate cuts. They attempt to direct capital toward productive uses rather than flooding the system indiscriminately. But in the current environment, where M2 growth consistently outpaces nominal GDP, they're clearly struggling to direct capital toward productive economic endeavors. The commodity price action may be magnifying this problem rather than resolving it. What happens if global economic conditions deteriorate? This is where the speculative rally carries substantial risk. Unlike the 2002 to 2011 bull market, driven by genuine industrialization demand from China's infrastructure build-out, the current rally is largely driven by excess liquidity seeking any yield. That creates a potentially unstable scenario. When prices are driven by fundamentals, corrections tend to be measured because buyers step in when value emerges. When prices are driven primarily by liquidity flows and speculation, corrections can be violent because buying pressure evaporates when sentiment shifts. I want to be absolutely clear. I'm not predicting a crash. I'm not telling you to liquidate everything. I'm explaining the risk factors existing in the current environment. This channel is about understanding markets, not pushing predetermined conclusions. You need to make your own decisions based on your risk tolerance and time horizon. Speaking of time horizon, let me share something important. If you're a long-term holder of physical precious metals, short-term price volatility driven by Chinese speculation may be completely irrelevant to your thesis. You're not trading futures. You're not leveraged. You're accumulating real assets for long-term wealth preservation. In that context, whether silver trades at $75 or $85 or $70 next month matters less than whether you believe the long-term trajectory trends higher. But if you're trading leveraged positions, if you're attempting to time short-term moves, if you're operating with capital you cannot afford to lose, the current environment demands extreme caution. The speculative dynamics can reverse instantly. Position sizing and risk management matter more than being directionally correct. Let me connect this to what you can actually observe. The Shanghai silver market is showing premium compression after an overheated period. Some suppliers are lowering quotes because transactions at the highest premiums have become difficult. The physical market is cooling while futures stay elevated. That gap eventually closes. When the physical market cools while futures remain elevated, that gap eventually resolves. Traders show very low intention to purchase and build positions under high premium conditions. This is direct market intelligence. People who actually trade physical metal professionally are stepping back. They're not chasing prices higher, they're waiting. Does this mean the bull market is finished? Absolutely not. It means the market is digesting gains. It means speculative excess is being worked off. It means we may see consolidation or correction before the next leg higher. Or it could mean a more significant repricing is approaching. The data will tell us. Your perspective matters. What's your read on the Chinese situation? Do you think the $7 trillion liquidity flood will sustain precious metals prices? Or do you see bubble risk that concerns you? Drop a comment. I read every response. Here are my 3 critical takeaways. First, the Chinese liquidity flood is real and quantifiable. M2 money supply growing at 8.5% against 3.9% nominal GDP creates excess liquidity seeking returns. Approximately $7 trillion in household time deposits maturing this year with limited attractive alternatives. Gold-backed financial products more than doubled, with 8-fold value increase over 2 years. This is structural shift in Chinese household savings behavior. Second, the divergence between futures and physical markets signals elevated risk. Shanghai silver premiums high, but transactions becoming difficult. Shenzhen market showing declining procurement enthusiasm. Manufacturing entities scaling back procurement. When paper prices surge while physical markets cool, that divergence eventually resolves. History suggests paper usually adjusts to physical reality. Third, the PBOC faces an impossible dilemma that may prolong this dynamic. They need to support sluggish growth, but are wary of asset inflation. The M2 to GDP gap represents a structural challenge. Until that gap closes, surplus liquidity continues seeking returns in commodities and precious metals. The honest uncertainty we face is whether the Chinese liquidity flood represents a sustainable tailwind persisting for years, or creates a speculative bubble, correcting sharply when sentiment shifts. Both scenarios are plausible. My view is that long-term holders shouldn't be shaken by this analysis. Short-term traders should adjust position sizing to reflect elevated risk. New money should recognize they're buying momentum, not value at current prices. Markets don't care about narratives, they care about flows. Right now, flows favor precious metals. But flows can reverse. Position accordingly. This isn't financial advice, this is analysis. Your decisions are your responsibility. Invest with logic, not emotion. Size positions you can hold through volatility. Stay informed as this situation evolves.